Hey guys, welcome back to the Mortgages AF podcast. I'm Mark, founder of Albion Forest Mortgages, and today I'm joined by Stuart.
Good morning.
Hi, Stuart. And today we're discussing joint borrower sole proprietor mortgages, which I'm personally a massive fan of. I really like them. We do a lot of them at Albion Forest, and they are really handy for first-time buyers to get on to the property ladder. So yeah, we're going to have a chat about them. What do you think about joint borrower sole proprietor mortgages, Stuart?
I think they're going to become more prominent actually going forward. There's a lot, property prices have been going up. I know we're in a funny time at the moment, but properties are not going to get much cheaper, and I think it's a great way for people to get support to get their foot on a ladder. So, yeah, I'm a fan.
Yeah, I think you're absolutely right. I think that's exactly what they're for, people to get their foot on the ladder. Um, but yeah, why don't we go through? We're going to go through some of the pros and cons of the joint borrower sole proprietor scheme and our frequently asked questions. So I think the first one and probably most important is what is a joint borrower sole proprietor mortgage?
Well, I suppose I sort of almost led into it what I was saying a second ago, but it's a type of mortgage where a parent, a guardian, someone in the family, or maybe even a close family friend can help someone get their foot on the ladder, on the property ladder for the first time, um, because they can use their income to support the person who's looking to get a mortgage, to help increase the financial input into a new property.
Yeah, I think that's exactly it. So, yeah, it lets you borrow more. So you can use mum or dad's, or like you said, sort of there's a range of different people you could use to allow you to borrow more on your property early on. A lot of them want to see an exit plan. So a lot of them want to have a long-term plan. So um, you're talking generally, they like people to be at the start of a career, for example. So you're going to have a clear progression in your career and you're going to go up the pay scales and get paid more over time. That happens naturally. And then a lot of sort of lenders will ask to not necessarily see evidence of that, but just to have a conversation about it, to know that you've spoken about it with your broker, and there's a plan for the person that doesn't own the property to come off the mortgage at some point. That's probably something we should talk about first. Actually, is we're going to be using it a lot today, but non-proprietor is such a weird way of. It's such an odd thing to say. Non-proprietor is not a normal word that you hear every day. So, what does non-proprietor mean?
Well, it's similar to a scheme that used to be out years ago. We used to have something that was called a guarantor mortgage. So it's someone who will help financially, and if payments for whatever reason got missed or whatever, that person would step in and they would be responsible for that. But they don't actually own the property. Their name's not on the title deed. That is just the sole name of the person who's going to be living in that property, because that person needs to live in the property, whereas the people who've come in, as joint purchasers, for instance, don't have to have that commitment.
Yeah, exactly that. So you've got the joint borrower, so you're both liable for the mortgage, or more than two people potentially. We'll talk about that a bit more in a bit. But the non-proprietor just means you're not not the homeowner, not the owner of the home. So yeah, I think it's interesting you mentioned guarantor then as well. A lot of people, if they're renting, they might have heard of guarantors before because it's quite big in the renting world. Having a guarantor, someone that will guarantee that you'll pay the rent. It was the same thing with mortgages; they would guarantee that the mortgage would get paid, and if you didn't pay it, they would pay it. And ultimately be responsible for it. And I think it's the same kind of thing with joint borrower sole proprietor to some extent. You're both liable for the mortgage, but only one of you is responsible for the house, which is a very odd situation that you don't get in any, as far as I know, any other situation of home ownership.
Yeah,
Uh,
and some of that, Mark. Um, I mean, you can have up to with some lenders, you can have up to four applicants.
yeah,
So it doesn't have to be just a guarantor. It's not a guarantor, by the way, but not just one, but you could incorporate up to up to another three people, as well as the person who's going to live in that property. So,
Yeah,
it really does give some really good environment, support to people when they're looking to lend.
absolutely. And the 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 thing about it is that you're absolutely right. You can have three people. So if you were one person, so you could then have mum, dad, and uncle, for example, potentially on
Yeah,
your mortgage to bolster the amount you can afford to borrow, and
yeah,
take from borrowing based on your salary, which could be say 20,000. You then use all of their income as well to subsidize yours and borrow a lot more. And I think it's a perfect way for people to get on the property ladder earlier, rather than having to wait until they're older to get on the property ladder and then and earning more. You can do it sooner as long as you can afford the monthly payments, and that's the main thing.
yeah. I mean, one other thing to point out on it is, with the people who are going to come onto this type of mortgage, their existing commitments and loans, everything what they've got themselves will be taken into account.
Yeah,
So if you've got a parent who's got an income of say 40 or 50,000, they won't necessarily be able to use the whole 40 or 50,000 against the income for multipliers. Um, but they will be able to use whatever balance there is left over once their existing commitments have been measured.
yeah, yeah. And that's exactly it, isn't it? So existing commitments, everything from sort of their own mortgage if they've still got one,
Yeah,
to their hire purchase agreement on their cars, if they've got a kitchen on finance, anything like that is going to all count towards the affordability.
yeah,
So you're not just taking on their income, you're also taking on their commitments for affordability purposes. So you're absolutely right.
you are. And the joint borrowers would also have to pass a credit check as well.
Yeah, that's important, and it's going to be logged on their credit file as well. So that's important for them to know, is that when they take out the mortgage, they are liable for the mortgage. It goes on their credit file the same way a normal mortgage would, and it will affect their credit rating potentially to some extent.
Yeah, this is not a reason not to do it, by the way. It's just like
Yeah.
because it is a fantastic scheme. It's just a case of like people need to just be aware of those sort of things.
Yeah, and I think one of the things that I know we were talking about before is the fact that they do have to be aware of a lot of things. So, firstly, the mortgage broker will likely talk to them about the implications of it, but also they have to get independent legal advice. So they have to speak to a solicitor who will explain everything to them, and they will have to sign something to say they've had it explained to them, and that's standard with well, as far as I know, all joint borrower sole proprietor mortgages. They have to get that independent legal advice.
Yeah, that's correct.
Um, Okay, cool. So the sort of the next thing, who can get a joint borrower sole proprietor mortgage? Now, this is one that we get asked a lot. Who can get a joint borrower sole proprietor mortgage? But I think the answer is just anyone really. There's not really a limit on who can get who can be the proprietor, as it were, on a the homeowner on a joint borrower sole proprietor mortgage. Would you say that's probably about right?
Yeah, that's spot on. Yeah, that's the case. I mean, there's even now that there's a type of mortgage out there which is like a reversed joint borrower sole proprietor mortgage, and sometimes this is for people who may be like a total flip to help the parent. And I know we're not going to speak to that today, but it just shows you it doesn't have to be always like the very young people that can do this. It could be anybody.
Yeah, absolutely. Yeah. So, I mean, we often, especially when I'm talking to clients and things, I'll often talk about it in frames of parents helping children to buy properties, just because that's the most common thing we see. We often see parents using their income to subsidize the children's income in order to borrow on it. But it does work the other way. So you might
Yeah,
have children that live with parents, for example, that want to use their income to help parents get a mortgage, or even children that don't live with their parents that have a good income, and the parents are older and maybe winding down their careers, or even they've retired early and they are just using the children's income to subsidize it on a shorter term basis, and that's becoming common as well.
yeah.
Okay, so we've talked about who can be the proprietor, so the homeowner. Who can be the non-proprietor, the non-homeowner?
Well, I think I probably tried to cover that a little bit earlier on in the fact that, this could be, it has to be someone who's close to you. I mean, most people think it's got to be a parent or a brother or sister, which are all legitimate people to do it. But, you could have a close family friend. Um, it's quite wide open to interpretation of who you want. But of course, it needs to be someone who's totally aware of the commitment they're giving on paper and legally.
Yep. I think it's worth mentioning as well that it will vary depending on which lender you go to. So we'll talk maybe a bit more about lenders later on, but there are lots of lenders that do joint borrower sole proprietor, and they're not all created equal. Some will only allow immediate family to do it. So some will only allow parents, brothers, sisters. Others will allow a bit broader scope. So you might get grandparents, uncles, and aunties, and then some even broader still. You might get that close family friend that you call Uncle Dave, but he's not actually related to you by blood, and things like that. They're going to allow that, sisters-in-law, brothers-in-law, things like that. They're going to be a bit broader. So it very much depends on the lender you go for. Is one of these things we. Of course, as brokers, we're always going to say go speak to a broker for any mortgage. I think with joint borrower sole proprietor, it's so much more important to speak to a good broker because it's so complicated. There's so many lenders that do it, and every single one of them have different criteria.
Yes, that's
Um,
exactly the case. That's exactly the case.
and yeah, I think that's really important. Um, One thing that I did want to talk about particularly is the term of the mortgage. Now,
Yeah,
uh, term of the mortgage is generally based on the maximum term on the mortgage, should I say, is generally based on the youngest person on the mortgage's the oldest person on the mortgage's age.
yeah,
Um, with joint borrower sole proprietor, you're often going to have someone that is, say, 50s, 60s, or even older than that, which means that you quite often going to be limited on your term. Do you think?
yeah. Yeah, that's true. And I suppose in short term, then, in times when you're needing these people's income to support where you are, because the mortgage is on a shorter term, it means that your monthly costs will be higher. Um, because invariably, um, you're going to be in a position where you may only be in a mortgage that might be 20 years long, or maybe less than that. And sometimes, depending on the age of the person, maybe a bit longer. I mean, the normal age that a mortgage will go up to is somewhere between the age of 75 and 80, depending on the lender. Um, Not everybody's the same. There's different criteria, as you mentioned earlier. Um, so if you had someone in their early 50s that could run a mortgage of 75 or 80s, it may be that you could get maybe a 25-year mortgage. If you had someone who's going to support you who's in their 60s, then it could be a 15 to 20-year mortgage. So, um, yeah, every case is going to be different. Um, but again, that's the reason why you probably want to see a broker, because the broker will know the best place to look at for you.
Yeah, and there are things you mentioned something there that, to be honest, I hadn't even occurred to me to talk about, but is really good to talk about. Is that um, the the shorter term means the higher monthly payment. So this is another thing where a lot of lenders will say that you need to have an exit plan for 5 years. So if you take out a joint borrower sole proprietor product, what's the plan over the next 5 years for you to be able to afford that mortgage on your own? And you don't necessarily need to have one, but it will be a much stronger case for a lender if you've got a plan of you'll be able to afford the mortgage on your own because you're a newly qualified professional and your income will dramatically increase over those 5 years, or you've got a partner who's just gone self-employed, so we can't use their income right now, but in 2 years' time we'll be able to use that income for their affordability on their own and things like that. So there are lots of reasons to use joint borrower sole proprietor to bolster that income in the in the short term, but they want to see that 5 year plan usually quite often with lenders. And if you've got a shorter term of 15 to 20 years instead of 30 or 35 years, the monthly payments are going to be much, much higher.
Yeah.
Which is, there are things you can do about some lenders will allow you to put some of the mortgage on interest only for those few years, which means that instead of bringing the balance down, your actually balance is going to stay the same for those few years, but long term you can change it to a repayment later on, but you need to still have a repayment plan for that chunk that you want to be interest only to bring those payments down. So there needs to be a way of paying that back at some point. Yeah, I think that's all really good. There are lenders that will go, they'll sort of almost ignore the older person's age. They are probably, well, they definitely are going to want to see a plan of what your plan is to afford the mortgage on your own. Because if they're going to ignore the age of the older person and do the mortgage based on the youngest person's age, then they're going to need to have a plan in place for you to get off of that joint borrower sole proprietor mortgage onto a standard mortgage.
More often than not, Mark, that would probably be on the reversed joint borrower sole proprietor mortgage. That's probably more often the case of where that will be, because it could be that the parent or the older life is actually living in that property, and they want to see that the younger person who's got a commitment on there is progressing in a way that they will be able to take that over should it need to be.
Yeah. Yeah. Definitely. Which brings us on to lenders. We've talked about lenders quite a bit, and the fact that they've all got different criteria. And one of the questions we're often asked is which lenders do joint borrower sole proprietor, and there are going to be articles all over the internet which will list them, but it changes constantly. Different lenders will enter the joint borrower sole proprietor market, they will leave the joint borrower sole proprietor market. So I can't sit here and go, these are the ones that you need to speak to. Blah, 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 blah. So that there's no real benefit to anyone to do that, and they all have different criteria. So there's no set me saying everyone should go to this lender first, because every single case is different, and every single case we do with joint borrower sole proprietor is going to go to a different lender almost. I mean, it depends on the personal situation, but it's the different lenders involved all have their own quirks. They all have their own criteria that benefits certain people, and it's very much um, a there's a best fit for each individual case.
Yeah. Yeah, and although some of these lenders will be lenders that you've heard the name of in the past, it might not always be the big high street lenders.
Yeah.
So there's a good variety of lenders out there who work within the parameters of joint borrower sole proprietor.
Yeah, I think that's absolutely right. I would say even probably the majority of them are probably lenders that you've not heard of. It doesn't necessarily mean worse rates,
Yeah,
but they are quite often the building societies rather than the big high street brands. But some of
yeah,
the high street brands are up there. Um, Okay, so what income can be used? So this is one that we do get asked. What income can they use? And this is a tough one again, because I find we're saying this almost to every question, but it depends on the lender ultimately what income can be used. But basically, it's pretty much any income can be used as long as it's declared to the government and things like that. So it's a case of, well, depending on the income you want to use, there's probably a lender that will use it. So even things like maintenance payments or benefits payments, obviously you've got the standard things like employed income and self-employed income, but like any form of income potentially could be used for joint borrower sole proprietor. And I quite often find when I'm doing joint borrower sole proprietor cases that we're looking at pension, we're looking at investments, we're looking at income from employment and benefits and maintenance. Everything gets piled in, and we're basically just trying to work out how much of that income can we use.
yeah, exactly. And the biggest one, especially when you're going to get a parent maybe supporting a child in this, could well be around pension. and people don't realise, that that can be used. If you're drawing a company or even a government pension now, you can use that to support as well.
Yeah, 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 absolutely. So the pension income's probably the most common that we use for the non-proprietor, for the non-homeowner, because generally they are a retired person, quite often in their 60s, 70s, and they're drawing on that state pension or that personal pension,
Yeah,
and yeah, that's the most common income we use, other than obviously the employed income.
yeah.
Yeah, so the deposit. I think this is another one that gets a possibly a bad reputation. So, how much deposit do people actually need to do the joint borrower sole proprietor scheme?
Well, that depends on the loan to value of your mortgage. So, I mean, you can get these up to 95% with certain lenders. It will vary, but you need to be looking at a very minimum of 5% of whatever the purchase price of the property is.
Yeah,
Um, yeah. So, but we do tend to find that maybe if it's a parent or someone close, some people may be gifting deposits as well, which really, really would help out the person who's going to be on the deeds.
absolutely, and I think that's yeah. I mean, gifted deposit is really common now,
Yeah,
and as you say, I think quite often we'll get the same parent that's going to go on for affordability is also gifting the deposit for the mortgage, and it does count as a
yeah,
gift because whilst they're going on the mortgage for affordability, they are still giving it to the person that's buying the property. So that's really common as well. And as you say, 5% is generally the minimum deposit required. Some lenders are going to require more. I was quietly snickering while you were talking about it because um, it was another thing where we just have to say, well, it depends on the lender. Different
correct.
lenders have different criteria, right? And
Yeah,
every time we say it, like every question we get, it's just the answer is it depends on the lender.
yeah,
And we could just say that for every question. I mean, we could have been done like quarter of an hour ago. But the yeah, depending on the lender, some lenders will let you do it with 5%. Some are going to need more, like 10 or 20%. And
correct.
there are even some that it depends where you are in the country. So they only do joint borrower sole proprietor for certain areas of the country, or they only do it at 5% deposit for certain areas of the country, just to limit the amount of business they get in because they're smaller, which is common as well.
Yeah, yeah, for sure.
Right, that's kind of most of the questions done. The other ones that I've got for you, Stuart, are what if someone's got bad credit? Can they still do the joint borrower sole proprietor?
It's becoming increasingly difficult with people with bad credit to do that. It doesn't mean that we can't, and it doesn't mean we can't search to see whether there's a lender out there, but it could really impact whether you'd be eligible or not to do this. Um, and I suppose this will probably lead back to deposits again, because if someone who hasn't got the best credit history, but a lender may look at it, it may be that you'll need maybe a 25% deposit or more. Um, but generally, depending on what the reason for the credit issues are, it may well be that that person may not be able to support this. Um, but there's for every negative, there's a positive, so there may
Yeah.
well be. But it's yeah, it is a bit of an unknown area until we know what the reasons and that for are.
Yeah, I think it's you were answering it there, and I was thinking exactly the same thing that I've been thinking to every question that I've just talked about. It depends on the lender, and it depends on how bad it is. So bad credit, I usually find comes down to a few different things. It's how much it was for, when it was, what it was for, and whether it's paid off now. So if is it a CCJ for a parking ticket that was 5 years ago and for 50 quid, then it's probably going to be less of an issue than if you've defaulted on a secured loan last year.
Yeah,
And like it always depends. So it's one of those things. Go speak to your mortgage broker. They will be able to tell you whether it's possible with whatever bad credit you've got.
Mark,
Um,
just on that,
mm,
and this is not part of what we're talking about, but just on that, one of the big issues at times with people is credit on things that are really quite small. And if I could give
mm,
anybody a piece of advice, is if you're in dispute over a bill for £50 on a mobile phone, or something fairly insignificant for a small sum, instead of becoming a bit bloody minded on it and thinking I'm not going to pay this, and you can go and sort it out. The one bit of advice I would say to people is if it's a small amount, and it's fairly insignificant, it is to pay that, and then dispute it, because
yeah,
what you don't want for small amounts is defaults, missed payments, CCJs coming up on your credit check. And sometimes, although our emotion will be saying it's not mine, I'm not paying it, there's no reason why you can't still dispute that or try and sort that out once you've settled that part.
yeah. I think that's pretty spot on. The amount of people we see, and they've got this tiny default or tiny CCJ for £40, £50, £60, this kind of thing, where it's the last payment on a mobile phone bill, or
Yeah.
it's a parking ticket that they didn't think they deserved, and or they didn't even know about quite often, and
Satellite TV,
yeah,
broadband, all that
yeah,
sort of stuff.
and it happens a lot, and people should uh just just tell your broker if you've got it already. As you say, if it hasn't happened yet, just pay it, and then you can try and get your money back afterwards. But it's going to be much worse for you if you don't pay it and it ends up being a blip on the credit file then.
Yeah.
Right. Last thing I wanted to ask you about was the pros and cons. What are the pros and cons of joint borrower sole proprietor? I personally don't think there are any real cons as such. I think there are some things that are you should be aware of more than anything. But what would you say are the pros and cons?
Well, we've probably covered a lot of the pros already, in the fact that it does support your lending power. It does allow you to buy a property you might not have been affordable or couldn't get on the ladder. One of the things we haven't covered actually is the stamp duty.
Oh, yeah,
um, because if you're a first time buyer, for instance, you're still going to keep your first time buyer status, and there won't be implications to the other parties on the mortgage, um, which is a really big thing. It's a
mm,
really big pro for all within this. Um, because if it was without this type of mortgage, if this was a parent or someone trying to give support to someone to get on the ladder, it may class then for the person who's giving the support as a second home if they've already got a mortgage.
yeah,
And there could be implications to stamp duty all over the place with that. So with this type of mortgage, there are no implications. So that's a really big pro as
yeah.
far as this
I think
goes.
yeah, that
Um,
I hadn't it hadn't even occurred
so,
to me to talk about that.
but there's lots of pros in there, and the big thing I suppose is it allows people to support someone to get onto a ladder when they probably couldn't have got on that ladder on their own. Um, Flip side to that is it is if there is any type of contact, there could just be literally the length of the mortgage because it could make it a
Mm,
bit more expensive. The person who's coming on needs to take some financial advice. Um, and I suppose the other thing to just mention, which is not really a pro or a con, is this can't be used with shared ownership.
yes.
Uh,
Yeah, that's another thing I hadn't thought to mention.
yeah, so this has to be, just on a traditional mortgage.
Yeah, yeah. I don't know about the other schemes that are out there. I don't see why you couldn't use it on a new build home as long as you weren't doing a shared ownership mortgage. And I have never come across the first home scheme, but not for joint borrower sole proprietor. There's just not enough houses on the scheme for it to have come up yet. But I imagine it would be the same because of the nature of the scheme.
Yeah.
The
When it was available, you couldn't use it on Help to Buy either, by the way.
Yeah, yeah. So I would imagine due to the nature of the other schemes that are available that you can't use it on those either. But yeah, I think the main pros we've got are you can borrow more, like way more, quite often than you would be able to borrow on your own. You can potentially do a mortgage depending on the lender over up to the age of say 80 on the oldest applicant, or even older potentially, depending on the income that they're using and their sort of age at the moment and all that kind of thing. Some lenders will ignore the older person, the non-proprietor's age entirely. So there are lots of pros there, and you can change some of the mortgage to interest only if you need to. The cons, yeah, I just can't think of a con. I can't think of a negative really to the scheme. I think in terms of the schemes available at the moment for mortgages and for home ownership and for getting on the property ladder now, Help to Buy is gone. There isn't really one that's better, in my opinion. That is a personal opinion, but I would say the Joint Borrower Sole Proprietor scheme is a brilliant way to get first-time buyers on the ladder, especially if they've got a clear progression coming up, like they're going self-employed and they need the extra income until their self-employed income kicks in and after 2 years, or they just are at the start of a career or something like that.
And the other thing, Mark, and I know you've covered it in various different ways, but even this doesn't have to be forever. This is, when you're in a position to take this on by yourself and you're renewing your mortgage or wherever that time will be. If you're restricted in the initial period to the oldest life and the term that you can have this mortgage for, this can be expanded when you can do this in your own right.
Mm. Yeah.
So, in 5 years' time, 2 years' time, whatever that period is, if your circumstances are changed and you can take this mortgage on your own now, then you can do that. And you can extend the term of the mortgage if you want, which would lower the payment, mortgage payments.
Yeah. 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 So yeah, exactly that. It's a mortgage can be changed at a later date, so you can take people off. You can extend the term. Yeah.
Yeah.
Fantastic. Well, did you have anything else you wanted to say about Joint Borrower Sole Proprietor?
I don't think so. I think we've covered it.
We have chatted a lot longer than as always. We had a lot more to say than I predicted, but I think we've covered off everything anyone could possibly want to know or need to know about Joint Borrower Sole Proprietor and how it can help them get on the property ladder. Yeah, thanks so much for joining us for another episode of the Mortgages AF podcast. Thanks for helping me out, Stu, as always.
Yeah, pleasure. Thanks for everyone.
And and we'll see you next time. Cheers.
Cheers. Take care.
Bye bye.
Bye bye now. Bye bye.